So we're going to be putting our crystal balls in front of us and figuring out where this is all going, what it's going to look like next year, the year after, maybe the year after that. And of course, we know about our crystal balls. They're not very good, but we'll do our best. So first off, we have Evelyn Grech. She is a private equity investor, board of directors of AlixPartners. But that really doesn't tell Evelyn's story. She is involved in private equity from seed stage all the way through some very large deals and acquisitions. So we're going to get a wealth of information from Evelyn today. Sitting to my left is Jay Freeman. He's the founder of BlackView Capital Advisors. Jay has made his marks in the turnaround industry and restructuring businesses. And while BlackView provides consulting and advisory services, it acts primarily as an independent sponsor. Is that right? Beautiful. And Gerson Guzman, who's here online. Gerson is the co-founder of Ceiba Capital Partners. Ceiba Capital Partners is an investment firm focused on buy and build opportunities in the lower middle market. So I'm looking forward to a lot from Guzman or Gerson regarding, what exactly people are interested in buying in this market, and what does he think people are going to want to buy 2-3 years from now? So it'll be great to get his input on that. My name is Heil. I'm institutional sales for Pacific Premier Trust. We deal in the self-directed IRA space. So people invest into alternatives through their IRAs. We help them facilitate that. I work with institutions where we're trying to set up an asset managers where we're setting up multiple accounts at one time, multiple people coming into investments, things of that nature. When you work for a bank, and those of you who were with us yesterday, I apologize, but I got to do my mandatory disclosure here. And that is, information is presented for educational purposes, is not intended as, and may not be relied upon as tax, legal, or investment as other advice. Pacific Premier performs the job of a custodian, and as such, we don't look at things from an investment standpoint. We don't recommend or endorse any particular strategy or product. You are advised to speak to your professional advisor regarding those investments. And as always, investments may go up or down, and you may lose principal when you're investing in alternatives. So my legal department is now very happy. I thank you for bearing with me. I know many of you, I recognize many faces and people in the room. When I do these, it really is a conversation between the four of us. I see Evelyn's now on our screen, so we can see her. So I want you to feel free to come, ask your questions. Don't wait till the end. Please just chime right in, ask them as we go along. I ask that you be concise when you make the question. And sort of cut to the point. We have limited time up here. So with that, I'm going to ask each of our three speakers to introduce themselves. Evelyn, I'm going to ask you to perhaps lead off and do that first.
Okay, hi, nice to be with you guys today. So basically, as Mark said, my background has been in private equity. I work for 2 large funds, Trust Company of the West, and I work Capital Partners. And in the past 4 years after we terminate my second fund, because one of our partners passed away, unfortunately, I basically have been working as on the board of directors and also working with family offices and working with the companies directly. So nowadays I am on the board of Studio VC, which is a seed stage technology fund. I'm also on the board of 2 companies that I'm invested with some other families. One is in food and edtech. And I also assisting 2 families, large family offices in acquisitions in the technology and the fintech space. And I also, in one of them, I also sit on the board to help to build strategic initiatives to grow revenues and market and so on. So my affiliation with AlixPartners was I'm a certified consultant. They call me a couple of times to look at some projects, and some of them are also related to the family office.
As I said, she brings a wealth of information and then her background there. So, Gerson, would you take a minute or two and just tell us about Ceiba Capital Partners and your background?
Absolutely. Hopefully you can hear me okay. Good morning, everyone. It's a pleasure to be here today. I guess to sum it up, I was part of the great resignation that we've all been reading about after 16 years at my predecessor firm, where I was a partner and member of the investment committee. My partners and I launched Ceiba Capital Partners this year. We are a lower middle market private equity shop focused on acquisitions of founder-led family-owned businesses with 3 to 15 million of EBITDA across certain specific targeted sectors. I think where we differentiate ourselves and our strategy specifically is around technology implementation and digital transformation of lower middle market companies. Technology adoption, I think, has been accelerated in this environment, but in many ways, these businesses lag taking on off-the-shelf, semi-custom technology to really scale their business. And with our focus on strong buy and build opportunities, technology and integration of that technology to accelerate the business is really our sweet spot.
Fantastic. Jay, you're outshining me here with the way you're dressed. I got to tell you, very nice.
He's on camera.
He knows.
Hi, everyone. I'm Jay Freeman, founder and managing partner of BlackView Capital Advisors. Like Gerson, we focus on lower middle market companies, particularly in the 50 to 350 billion dollar total enterprise value space is where we like to target. Excuse me. Also, I would agree with him in saying one of the biggest things that we identify in that space is the lack of technology adoption, both from an ability to and sometimes a willingness to, depending on who the founder is. So we do like those opportunities. Currently, we are focused on direct investment opportunities, particularly for family offices. We feel like there's a gap in the market for those type of opportunities where they're not seeing it from the larger firms like the Blackstones, KKRs, et cetera. And a little bit more about BlackView Capital. Our name derives from my time in turnaround and restructuring, and it is the focus on finding indiscriminate opportunities, getting back to the black. And view is just based on the ability to identify those. So that's a little bit about our name and how we came to exist.
I'm glad you filled that in because people can make wrong assumptions. So fair enough. Great job there. Jen, I'm going to start with you. In our prep call, you had some really interesting perspectives about the private equity industry and how it's changing. Not just the valuations and finding deals, but how deals are being structured and given the high valuations, the pressure it puts on managers and the impact of technology on the industry. Just talk a little bit about that and share your view.
Yeah, I'm going to take advantage to be able to bounce off of Gerson again. And, it's ironic. I think one of the things that, this time is being called the Great Resignation. I would actually challenge everyone to think of this time as the Great Transformation and Adaptation. And I say that because of two things, particularly in the area that we focus in. Again, technology is here. I think we're looking at a transformation of businesses that previously felt that they could not do business away from home. People couldn't work away from home, and now they can. I think that's opened up a great opportunity for companies in the middle market to be able to access talent that previously they didn't have access to because they felt the same thing. Ironically enough, though, it's also put them in a bidding war to compete for some of their local talent that they currently have around them. So it is a unique position, but it is an opportunity nonetheless. Along with the transformation, I think we're looking at entities such as the Fed that are now taking on different roles that we've traditionally seen them take on. Traditionally, it's unemployment, interest rates, monetary flow, et cetera. Now they're stepping into places such as ESG, social impact, things of that nature. So again, we are now witnessing the times that we used to, or the things that we used to see transform, and businesses need to get along with that. To go back to the point of valuation, I think one of the biggest areas to be able to kind of take a look at valuation and say, okay, if we're looking at valuations that are exponentially, depending on where you think we are in the market cycle, extremely high and may not continue on for another time period, how do you enter into a business or get into a business where you can kind of transform that multiple to be a lower entry multiple? And I think technology is one of those ways where you can go into a business and say, okay, yes, we entered in at 6, 7, 8x maybe, right? And there's something that's within that business that you can align with something else, where technology ultimately reduces some costs within that business, and maybe it lowers your entry multiple at 1 or 2 turns. I'm going to pass it back over to you.
Beautiful. There was a lot in there, so thank you. Gerson, actually, I'm just going to flip it over to you and have you respond and share your thoughts.
Yeah, thank you. I think definitely the remote workforce and hybrid environment has enabled folks to pursue different careers. And it's challenged businesses to figure out how they're going to manage their workforce going forward. At some point, we will get through whatever the latest variant is, but I think the workforce as a whole will be standing up to their management saying, look, we can work remote. I need a flexible schedule. And I view this as a tremendous opportunity to bring workers into the fold that before had not been able to because of their own personal constraints, in particular, greater opportunities for working mothers. And I think there's business models around that present some unique opportunities as well. From a valuation perspective, look, we all sit around. We've been sitting around for the last 15 years complaining about having to buy B-rated businesses for A-rated prices. I really don't see that changing in the near term because of the continued capital overhang that is out there, as well as the low rate environment that we continue to operate in. And I don't foresee that rate environment changing dramatically near term, even in an inflationary environment. So I think ultimately, as my fellow panelists said, it's about how do you think about post-closing value creation to drive down that forward multiple, and then create a business that is materially different, better, so that when you go to exit, you get to capture that alpha.
Gerson, I want to particularly ask you, because really since about 2010, 2011, we've been in this low interest market environment, if you will. And during that time, there's been a great deal of acquisition and purchasing of companies, and it's been really a boost for private equity. My question really deals with, has the market's become more and more efficient, obviously. And how are you dealing with that now? What's that driving you to do? How's that changed how you look at opportunities or where you look for opportunities? How does that impact your operations?
Great. Thank you for that question. I think you are right. We've been operating in this low interest rate environment for a very long time. What has changed is the amount of money that has flowed into alternative assets. So you've got a lot of pressure. Folks are over equitizing deals. It used to be you could get an LBO done with 30 to 40% equity, and now you're seeing those equity checks go up. That is driving multiples up. And for us at Ceiba, it comes down to our sourcing strategy and really being focused on how do we turn over those rocks, especially on the lower side of our target range, that 3 to 7 million in EBITDA opportunities, where we think there's still inefficiencies, where we still have a shot at being able to get in front of a seller with 1 to 3 other buyers and have a conversation around why we are the best partner and compete both on a full and fair price, but also on relationships and the ability to demonstrate what that post-closing value creation pathway looks like for them. Because at the end of the day, we understand that this is their legacy. They care for their employees, and they want to make sure that they have the right partner there. And I think that's where we're able to still drive some value on the front end in seeking out those opportunities.
Evelyn, it's kind of interesting to me because you work with several organizations. And I guess what sort of interests me about that, and they're at different levels, at different points within the capital structure there. Some are early seed, some are later, well-formed deals, some are quite large deals. Talk to me a little bit about how you bring value in each of those areas and why a family office or an organization needs somebody like you to help them do what you do.
Yeah, so you have different investment criteria. And for instance, when I mentioned the seed stage venture capital fund, they have their investment strategy. So you know exactly how to advise them and to help when they're sourcing deals and when we bring some deals to them. But when you go into the other area that I work with is late stage VC and early stage private equity, the challenges have been the same. I always been the acquisition side. So, and as Gerson said, assets have been expensive for the past 15 years, and I don't think it's going to change. But it's always like that. Whoever is buying things is expensive, whoever is selling things, they deserve more. And what is really challenging, and has been really challenging now the past couple of years, is that is a bidding war for the good companies. So you have the capital. In the past, you had the capital to throw more money and win a bidding war. But right now, the companies, they are selecting us. So it's like, I don't want to. I need you to do this, this, and this for me. And even if you go and say, listen, but if you change, and then you have to kind of sell yourself to be able to be the investor and prove that you can bring them to the next level. This has been, I've been in this business doing this for now almost 25 years. From 20 years ago, this is a major difference that we need to teach how we can really be of value to a company that is, as we have 50 million, 500 million in sales. We're not talking about, a $1 billion corporation. And then in the venture capital side, what is amazing when you go to late stage, you have companies that have revenues 14 million, and they are raising capital in like less than 30 days with all the big venture funds, with a valuation of $3 billion. You're like, okay, then you go to your private equity background, that when you look at private equity, like hardcore, middle stage companies like, everybody else in the panel invests, it's hard to make this shift because in those companies are like value, primarily they are not just technology, they're more, other type of industries like food, retail, e-commerce, you name it. You really want to see the growth for the product, the market, and the revenues. And these kind of attach to the valuation. But when you go into a company that has $14 million in revenues and maybe it's going to have 50 million, the year after, and people are throwing money, that's the venture capital world, at a $3 billion valuation. So this is when things get confused, and you really need to separate your different skills. So you're right, it can be really hard when you analyze a acquisition for a late stage technology company in the VC space, and then you're looking at an acquisition in a lower middle market for a company that's either, in fintech or food or, another area. So it has been very challenging, and you have to, and the CEOs and the board, when you were pitching, I just went through an exercise, the past 6 months, and yesterday ended not very well, because basically, we didn't pass the cut because I was with a family office. And even though we had the money, we could help, the other fund said, nah. The big guy said, no, we don't need you to sit on the table with us. And we didn't get the deal. So to be in a family office, and before I was in a fund for many years, right? I was in the fund. It's so different. We're sitting in a fund, primarily if it's big, you are with, other funds. But if you have a family office, you can have, 10 billion available. And to join the club is hard.
Very interesting. You raised a number of good points in there. I want to pick up on one of them, and certainly it's a theme I've heard before, and it's, today everybody has a banker. Everybody's out there selling, right? And how has that impacted the business and the industry from your perspective? Gerson, I saw you smile, so I'm going to toss it out to you first.
Look, not all investment bankers are created equal. I'll lead off there. And that has nothing to do with the name or the logo on your business card. It's about skills. I have found intermediaries, while they drive a more efficient process, especially with founder-owned and operated businesses, to be good facilitators for a deal. Because, and we talk about this a lot internally with my team, we buy companies for a living. We understand the tempo and the tenor of a process. Most business sellers will sell one company in their entire life. They have built a great company. They've not gone through the process of third-party diligence. And in many ways, they think you should just be able to show up after reviewing the financial statements and get it done. And so a good advisor is able to substantiate the process, and where they earn their fee is at that point where, to use a sports analogy, you got the ball inside the red zone. The natural tension of a process leads you to negotiate certain aspects related to diligence or structure, and that advisor can help bridge the gap and make sure everyone understands why, and the seller feels like they don't just have some New York Sharpie taking advantage of them. That being said, I think if you don't have a good advisor that way, they can be an impediment to a deal as well. But overall, our experience has been positive when we've had experienced advisors in a process. Now, I'd much rather be able to directly source opportunities and, get a bargain, but that's not scalable. And I recognize that. So I prefer that efficiency contribution from the advisor community.
You raised a really good point during the discussion there. And that is, you've done this many times, but the buyer, this is usually his first time going through this experience. Sometimes you have serial entrepreneurs who've been through it, understand the business, how it's done. But oftentimes that leads to some interesting dynamics during a deal, where he gets cold feet, or he's just unrealistic with his expectations. Talk to me a little bit about the role of the investment banker and how they can help smooth out that from your perspective.
Well, I think it's just that. It's being able to educate them and hearing from someone on their side as to what the process is going to be and the reasonableness of our requests. We pride ourselves on making sure we're not asking for the same information over and over. Every process hits the point with founder-owned businesses where they say, "Well, I gave you that," or we thought we'd given you that. Oh, yes, we got your financials when we first talked to you in June. We didn't enter into the letter of intent until September, and now we're sitting here in December. Could you give us a bring forward? And the advisor, again, can facilitate that conversation and help the seller understand what's going on. And in many of the businesses that we invest in, especially within our healthcare vertical, they're not financially oriented businesses. They are in it for profit, don't get me wrong, but taking a look at a P&L analysis and a quality of earnings and adjustments, that's just not how they're wired. And so again, the advisor can really facilitate the flow of information.
Great. Jay, I'm going to flip it over to you here. And tell me just about a recent deal maybe that you have invested in, how you met the person, what was the process like? Sort of take us through that whole dynamic.
Yeah, so I would say, I think one of the other unique things about what we're doing is we're using what I'd like to call next level data to try to find deal opportunities as well. And so again, that's using data analytics to find trends to kind of really build a thesis around what we see going on in the marketplace, and then finding ways, some of your traditional ways, some of the third-party providers, S&P.
Were you listening to Art this morning?
I was not.
You were not. Oh, you missed him. He spoke a lot about how the information is coming out today, and the analytics behind all that is driving things. So here's an applied application of what Art was talking about this morning.
Yeah, and so ironically enough, and I will kind of be able to circle around on both things that were just spoken about. So utilizing some of that stuff, we started finding out about an industry where it's a U.S. industry, particularly there are only 500 players that operated in this space. And there's a great opportunity. We ended up finding out about a portfolio company that we're working on to kind of spin out of a publicly traded insurance firm. And then from that, right, so they had a banker, right? So we kind of found out about the industry, doing some analytics work, got introduced to a company that had a banker. Now, from doing that deal and thinking about a buy and build strategy, we started reaching out to other players. Ended up, got lucky. One of the firms that we were talking to was a 2-person firm. They said, "Hey, listen, we just kind of started off. We're not looking to sell, but there's some interesting companies that we consult for that are larger that we think may go well with your buy and build strategy." There was a woman out in San Francisco who owns her firm is a SaaS derivatives accounting advisory firm that we got introduced to. Now, she didn't have a banker. We kind of went through a process. Unfortunately, we weren't able to get the deal. We kind of got, our legs cut underneath us at the 11th hour. But I think, again, that kind of gives you a holistic view of the process of going in, how you can go about finding deals, how you kind of take that and you ideate around how you can build around that strategy, and then utilize other opportunities. I would also like to say, again, right, this was a woman-owned firm. One of the areas that we kind of, we found that there is, I guess what I would call like digging where other people aren't, are these firms that are run by either minority or women-owned entities. They are either not comfortable with people in the capital markets, right? It's one of the reasons, the first thing she spoke about when she, when she took our call, she said, listen, I get a call a bunch of times, but there's always these bros that are calling me that want to do business with me. And she had absolutely no interest, right? So kind of looking at opportunities in these spaces where people who are either, going back to what Gerson said, they're looking for a particular type of person to do business with, or they haven't previously been comfortable with the industry, and now there are opportunities to kind of come in and have one-on-one conversations, get them comfortable with what the process will look like, and kind of going back to our other thing, these are also firms where the valuations you're not seeing such extreme, you can find a lot of value, you're not seeing as high multiples, because these people, part of them owning the firm is they have access to certain, I guess, business flow, right? That may be tied to them being a minority or woman-owned business where anyone can't just come buy them out. And I think that nugget actually fits really well for the family office type of investor because they can be more flexible. Whereas if you're a traditional fund, you've got your exit time that's you're really strict around that or what you can do. So what we're seeing, opportunities that we can create for some of the investors that we're looking at, particularly around the family office space, are looking at those spaces where other people are not, and being able to kind of bring them flexible deal opportunities.
Yes, so it's not only people aren't digging there, but there's a reluctance from the buyer to even play the game.
Correct.
And you sort of have to bridge a cultural difference while also doing digging in an area where people aren't digging.
Exactly.
So that's got to bring in a bunch of different dynamics. Rob, I was thinking you might chime in here, so your hand went up at the right time.
It's been good commentary. We've got a number of portfolio companies in manufacturing, and some in tech. Maybe Gerson, and then I think Jay, which are coming as well. But for the panelists, I guess Gerson said something earlier about sort of bidding on something that was prices were tough or and the like there. How are you guys sourcing interesting opportunities or getting there? Because I think part of your duty is to find transactions and execute them. You don't want to just sit on your hands and sort of live off the managed funds. So how are you guys sourcing and executing? Because I thought, Gerson, your point was interesting, but I think sounds like you're doing some pretty good things too of navigating and finding opportunities for integration.
Yeah, I'm just going to repeat it very quickly so everybody online and hopefully Gerson, you can hear this too. It was directing a question to Gerson, although he wanted all the panelists to comment on it. And dealt specifically around sourcing transactions. Was there anything more? I feel like I left something out.
Yeah, I mean, it was a little bit deeper than that as far as certain advice. And I think, Evelyn probably has some interesting angles from the institutional side, or maybe the female side, or Jay from the diversity side, but they can run with it.
I got it. Okay, so the question is, when you're dealing with high valuations, and you're dealing with a lot of pressures that Jay was just mentioning, you're dealing with cultural differences, you're dealing with people that aren't comfortable or are used to dealing in this market. How do you approach that? How do you source the deal? How do you find it? Gerson, particularly wanted your input and thoughts on that. So why don't you lead us off?
Hopefully I can respond. And look, we launched in mid-September. And for us, the proof is in the numbers. 3 to 15 million in EBITDA targets. Year to date, we checked these numbers about a week ago. We had over 500 qualified opportunities of that size or greater. We are practicing what we preach because while our strategy is focused on technology and digital transformation, we are using technology and digital initiatives to reach a broader market. I think of the intermediary community as a pyramid, with the broad base of that pyramid being small boutique investment banks, single shingle advisors, consultants, et cetera. And we're reaching out to them in order to see those opportunities. So really, I think in certain ways, technology has broken down barriers, but also facilitated a way to scale your sourcing initiatives. It used to be, right? You'd send someone on your biz dev team to an ACG event and glad handle a bunch of people or identify a conference and get out there. Now, through some targeted initiatives, we are able to more broadly reach folks and stay in front of them with relevant content and relevant information as to our specific verticals. And that is how we are driving the pipeline. Now, filtering the pipeline, the quality of the pipeline, and being competitive in this rising multiple environment, that's a different story, but we are looking at those metrics of what we're seeing come through.
So you're really using technology to educate people on the other side? Is
Correct.
And is that strictly entrepreneurs, or are you doing service providers around that, other investors? Talk to us a little bit about who you're sending your
Yep.
education pieces out there.
I mean, the first thing we did, even before we hung out the shingle, was get the CRM in place. Between my partner and I, combined co-founder, combined Rolodex of over 9,000 names, 4,000 plus unique entities, sorting them out by the type of potential deal source they were, and then thinking through what's our communication strategy for them as we're reaching out to them. And that is how we've really taken that data-driven approach to that outreach.
And Marty, you had something?
So yeah, I have a couple of questions. I mean, you guys are talking about COVID as a catalyst, but what about this large group of baby boomers who are retiring and trying to get, sell their businesses? That's number one. Number two, what about the ability? So a lot of baby boomers have like mom and pop businesses, but a lot of companies are approaching it as, hey, we can roll these up and then like do a SPAC or something like that. So can you talk about this wave of retirees that people have been anticipating for a while and a long time, number one, and that impact on private equity deal making? And number two, these new alternative ways to exit deals and what that means for private equity.
Okay, so just quickly here, Marty, it sort of ties into a question I was going to ask Evelyn, so it's great. So the first one is dealing with baby boomers and the fact that they're now reaching, age where they're thinking about retirements and wanting to exit their businesses. Some of these might be lifestyle businesses. Other ones, though, might be ongoing enterprises that could have succession tied to them. Specifically, those that might be able to roll up or do some sort of strategy and then, be exit via SPAC, exit via private equity firm, exit via family office, or some alternative source out there. So, Evelyn, do you want to talk a little bit about that and give us your background? And I would particularly tie in that one of the things I find interesting going on in the industry now, and didn't used to happen a lot, is in the VC markets for the companies to exit out to private equity firms. So you can build up a venture capital company to a certain size and then exit to a private equity firm and let them take the next size where.
Yeah, so that's I wanted to follow up also on Gerson answering your question, but also following up what Gerson was talking about the deal flow. So from early on, I haven't really relied a lot. I get around 100 pitches a week from all sorts. I mean, through LinkedIn, through email directly, and then it comes from brokers, from investment bankers. And that has not been, I haven't found in all those years the best possible investments and projects coming from, brokers or investment bankers. I have done what Gerson has been doing. What I do, I go over my network and I try to keep it really alive. And most of my deals come from other funds or from entrepreneurs that I have worked with before. And that's funny that you guys are talking about the baby boom, is that I have a lot coming from one entrepreneur that knows that his other family wants to sell, and And this has been the best source of deals. And again, as you said, for the private equity investments, the family, which is a company as well, that I'm helping, is they want larger deals. It's between companies that have 100 million to minimum 500 million in revenue. So those are like more larger acquisitions. And those are not going to be presented to me by investment bank. They're going to show to the larger fund. So I need to source that in another way. So I really go through the network. Another thing that is really useful is to go to, in the case of the later stage VC or the VC that is moving to the private equity space, is to go to the earlier stage investors. And so I have a very good network now and Rolodex, which I didn't have 2 years ago, for angels, Series A, Series B investors. So they want to exit, and it's not an IPO, it's continuous to private equity, and that's a source to get into the company and get close to the company, and then you have to get close to the funds as well. So I found that this is more time consuming, but the quality of the deal flow is much better than if I keep, trying to figure out all these pitches that we get from the banks. I mean, they're useful too, but they haven't shown me anything. I think they will show to Gerson, not to me, a good deal, because I'm with the family offices. It's like, a lower level in their mind,
Jay, I'm going to throw it out to you just a little bit. Particularly, I want you to address, Brent, you spoke about how you use data analytics to help drill down and find opportunities and things like that. So walk us a little bit through your analysis there, but then go back to Marty's question, or maybe it's part of answering Marty's question about boomers selling businesses and roll-up opportunities and new ways of exiting companies that perhaps weren't so popular 10 years ago.
Yeah, definitely. So we've kind of developed some proprietary tools internally, and then there's some outsourced companies that we use that kind of are able to take massive amounts of data. Again, they send it to us. They're offshore, a couple in like Pakistan and India, and then we take that data, we just look for trends, and then kind of try to take, it's a little, I guess, a sandwich look. Some macro and top down, and then some bottom up, and find our way in the middle. So I think that's one part of it. The other thing is, one of the things I got crucified for while I was looking for a job was kind of switching industries. Started off in banking, then moved to some consulting, did private equity. But ultimately, what that has done for me personally now is giving me a broad network of people who are looking at deals at different entry points, right? So if you're a consultant, particularly I work in the turnaround structuring space, they're probably getting a call before the banker, right? They're getting a call to kind of figure out things. How do we get in? How do we solve things before it may be distressed? Or even some of the turnaround attorneys that I've used. So my network is definitely helping out. I don't look at as many opportunities as Gerson, but I would say that we are looking at high quality opportunities, things that we want to get involved in. And it also means if there's not a banker involved, or if we can get in front of them maybe before the process, we can build up some of that relationship where we stand out as a better buyer for maybe something outside of price. I think one of the things that Marty brought up was the baby boomers is very interesting. That's kind of been the play in the lower middle market space for a while. One of the unique things we are seeing, and I think this was brought up in Miami, more particularly for the family offices, but we're seeing it in business as well, is generation 2 and 3, right? Maybe they've kind of started to transition, taking over the business already, and maybe it was hey, listen, I'm going to take over the business for a while just because mom and dad want me to, but ultimately this is not my dream. And it's one of the spaces where, no knock on any of the more seasoned people, but myself as a younger person has been able to identify with the second or third generation person who is now in charge of running the business, or maybe in charge of what the future of that business is going to look like. So being involved with them is saying, okay, maybe you're not the head right now, but you are going to be taking over the firm and building a relationship with them. Whereas maybe some of the other people, again, your traditional bankers or your traditional PE people are not able to identify or lack the ability to kind of really connect with those people.
And Gerson, I'm going to throw it your way. I know Marty's got his hand up. We'll get to him in a minute, but particularly since you deal in the lower middle market and you're looking at these types of opportunities, talk to me a little bit about the baby boomers and their perspective on things and what they're looking for. I mean, it's, a lot of them consider their business their family. And you run into those whole issues where they feel like they're somehow letting down the family by selling, and how you work for those and how you comfort and take them all through that.
Look, I think anecdotally in the last 5 to 7 years, I've seen a bit of a bimodal distribution now in sellers. So it used to be that in the lower middle market for founder-led and operated businesses, to a T, it used to be some curmudgeon old guy, 65 to 75, who's been told by his wife it's time to start thinking about retirement. 3 kids, one wants to be a doctor, one wants to be a lawyer, the next one wants to be the rock star. None of them want to be in dad's business. And so that was where we were plying our trade very often. What we're seeing now is actually a shift in quality of life issues as well. You're seeing younger sellers who have younger kids and they're saying, I don't want my job to be all encompassing. I want to stay involved. I want to continue to grow the business, but I need some balance. I need some liquidity, et cetera. So we are seeing that bimodal distribution. So we're seeing more deal flow because we're seeing the traditional baby boomer generation looking to exit, and then this younger cohort as well looking for partners. But to go back to your question, it really is, part of our approach is we're kind of therapists to the family and the seller in terms of what this means. The identity that a lot of these entrepreneurs place on the business, this is how they define themselves, and thinking through what the succession and the transition plan is going to be and how much they want to retain, what role they want going forward. And our approach is very collaborative. We don't just close the transaction and close the door on the first generation. We look to get them involved in ways that they're more interested in being involved. And that's generally worked well for us.
I want to just flip back to Jay here for a second. I think as an independent sponsor, you're in somewhat of a different situation than people who have pooled capital available to them right away. So you're looking at a deal and you're evaluating an opportunity. You've got to also be thinking, how does this play with my group of investors that I know I'm going to take the deal to? So talk to me a little bit, the algebra that goes on in your mind as you look at them, as you play this out.
Yeah, definitely. I think, one of the things is, given the time period where we started, is one of the reasons why I decided to go with the independent sponsor model, just to kind of start off. Right now, we don't want to be forced to put capital to work, particularly in an environment where if you're looking at what your exit multiple may be, it may be different than where you interact. And if you can control, again, one of the things we do like to do is control what that exit multiple is to kind of reduce it, but sometimes you can't. And so one of the things at least I prefer not to have to do at this point in time, is to be forced to do deals with committed capital. With that being said, I think kind of to circle back, we one of the things is just the value proposition. Again, bringing really good deals that allow them to kind of come in and almost, I don't want to say dictate terms, but there's more flexibility in the terms when you're doing a direct investor or a co-investment. Again, these are opportunities that you're not getting to see if you're in a fund, right? Like you send your money out and it's blanket, they invest in what they invested. You're almost automatically, right? You're on the advisory committee. You kind of have part of your own underwriting process. And the other part is selling the story. And I think, again, it kind of comes full circle in when you are talking to a buyer who's owned a company and it's kind of their baby, and you have a family office, generally there's someone else who's kind of been through that, right? Like that's how they gain their wealth. They built a company out. And so marrying those two, getting the story together, it allows you to draw a bridge between the comfortability of the seller, comfortability of the family office or the people who are investing in it. So it kind of becomes this kumbaya moment that we found is very interesting.
So when you do a deal, is it typically one family or one group backing the deal, or is it multiple?
So it really depends on size and structure. One of the things that I personally like to do are family offices that have a certain level of sophistication, because we obviously there's leverage on these deals. Some of these family offices are accustomed to actually having some sort of credit with the deal as well. So we come in, and if there's an opportunity for them to be in, or maybe the mezz piece and then the equity piece, it really makes them attracted to the deal. If we're looking at something, again, we try to identify opportunities from $50 to $350 million. So if it's a $50 million total enterprise value deal, that's probably going to be a one family deal. I'm currently looking at an opportunity, kind of going back to sourcing. There was in the space where I like to call one of the things that we're looking at going forward is X as a service. So you throw whatever X is in front of it, but supply chain management, which is really big now. We had someone who was brought into a big company. That company does roughly, let's call it $600 million in sales. They had a division that they acquired a couple of years ago. The person who was in charge of running that division left. That part of the portfolio became distressed. We got in contact with him through the grapevine. He realized or heard that they were looking to exit out of that business. So now we're having that conversation. That's probably a deal where we're going to have more than one family office in, just because of the structure of the deal and the type of capital that it will need to get done.
Great. Marty, you've been very patient.
We have about 5 minutes, but I have a very quick questions to ask. So the first question is, and you can write down another, so do we have to reevaluate how we buy smaller businesses or lower middle market businesses based on the assets they hold? So I'm gonna give you an example. There was a guy in Brooklyn who's like a guy who had ran import export. If anybody is old enough, you remember when stuff from Japan was really cheap, right? And everybody was like, oh, you might. So he would import stuff from Japan. Japan got expensive. He started importing stuff from China, and he had these massive warehouses in Brooklyn, right? And he said, oh, just exactly. I think it was Gerson, or maybe it was your comment. Son went to Harvard Law School, daughter went to Yale Med School, and they had no interest in his business of importing five and dime stuff, right? He says, I'm 75 years old, I gotta get rid of my business, who will buy it? So we found a buyer, and the buyer says, the real estate assets on this guy's are unbelievable. He had like 3 blocks in the center of Brooklyn, not far away from where, the Nets are playing basketball now, right? Barclays Center, right? But totally unrealized. It's like 2005, 2006 before everybody knew Brooklyn was going to take off. And so, should people be reevaluating? Because that's one of the things of private equity is hidden asset value, right? You own these things, and boy, you own land in Brooklyn, right? And all that land is now converted into multifamily. But so that's one. Is should you be reevaluating things based on
Put that one out there first.
Okay.
So the question was from Marty, and I want our panelists, I want people online to hear it, is should we be reevaluating businesses as you're going through an acquisition process based on the assets they hold? Sometimes the primary business generator isn't the crown jewel of the deal. And if they have the real estate underneath it, or it might be something they
assets
hold.
have gone through.
Yeah. So I'm gonna toss this one out there.
Yeah, I did a deal like this, exactly. In 2019, that's the deal that I invested, and then we already exit. So it was a company that was a builder of like prefabricated buildings, right? So they had like 3 different, and they were exporting a lot. So we looked at the books, and the sales and the trading, and when we started really looking at the balance sheet and analyzing the due diligence, they had exactly something like what Marty said, that they had like a plant in the middle of a town in Massachusetts, that the value of the building was incredible. And then we started looking, and we found the hidden assets that we found, and we end up, this is a company that wanted us to buy 50% of the company because they had $150 million in debt. And we found the hidden assets, we didn't tell them at the time, but $250 million. And those were buildings. And then we found out that they had a lot of tax credits that they never collect for the government from all the exports they did. And basically you have the rights for those, but you have to request for, the cash and the check to be sent to you. And from that, we basically did a lease back from one of the plants that was a very valuable building. The other one we sold. And so we bought the company 50% for 150, and we came in and we recovered immediately $280 million. So definitely in private equity, this is one of the best things you could possibly have.
Marty, do you have another question, or you jump in?
I wanted to take that as well. I think, Marty, one, thanks for uncovering some of the secret sauce. I think some of the larger firms have been doing that. I will tell you, one of the things, we're looking at that play, and COVID has really kind of accentuated that. And I say that because what you're seeing now is, I guess, what we could also call is the great migration, right? People moving from big cities into other places that are close enough where there are things going on. I will use Omaha, Nebraska as an example. You have PayPal, you have LinkedIn, Amazon just built a data center out there. So we are looking at opportunities where there are good businesses there that may actually have real estate, and we're looking at what the market looks like. What else is driving the market where, yes, maybe you can get in, and that is baked into some of your thought process, again, of lowering that exit multiple of what's transpiring around this business entity if they own the real estate. So that is one of the strategies that we're utilizing, and to kind of, again, give away, Omaha, Nebraska is one of the places where we are looking to execute that strategy.
Got about 2 minutes, you want to get
Yeah.
closing statements?
Well, I was gonna, if you don't mind, I want one more quick question. I think it's a little different than what we've been talking about, but working a deal, particularly when you have multiple investors who maybe agendas don't align. How do you deal with that situation as you're working with the company? You're obviously trying to drive it, grow it, and get it to a certain point where you think you can exit. How do you work with that?
I'll start. I'll say one, I was fortunate enough, I put myself through college running an online mortgage brokerage platform. And a lot of the deals that we worked on during that time period were purchases. It's when everyone was able to purchase a home. And if you've ever purchased a home, you know how many players are involved. So I got a little bit of background on kind of how to manage a deal from that experience in college. Fast forward to what we're doing now, I think a lot of the same principles apply, right? People, everyone is focused on the dollar amount. You have to also understand people have egos, and everyone else does not necessarily, although there's a timeline on the deal, the inner workings of other people's business have other timelines that we are not able to see. So if you keep those things in mind, and the first thing is check the ego at the door, you can really try to drive the point that everyone has the same goal in mind, which is to get the transaction done, and find out if there are ways to facilitate you assisting. Right, I think that's one of the things people get so caught up in. What they're doing is ultimately important. And if you just ask, hey, is there a way that I can help you? The other thing I would just say is, I think we've all grown up in the space of being preemptive, right? At times kind of managing up. You go ahead and manage up to your boss's expectations. While I don't have a boss, I'm managing up to what my other counterparties' expectations may be or what their needs may be, and try to facilitate acquiescing to those, maybe even before they get to that part of their timeline.
I'll be putting the emphasis on brief here because Marty is signaling that we have about a minute or two left. So, Gerson, I'm going you to deal with the same question because I know.
I think I'll be brief here. The stakeholder we often work with is the continuing management team, because they're the next generation. They're saying, "What's in it for me?" and "Who are you?" So working with them and explaining what it will be like to work with us as a control equity investor, and then what does the equity incentive plan look like, and the potential different levers for value creation for them.
So with that, Evelyn, I'm just going to give you one quick last word, and then I'm going to wrap this up and turn it over to Ben. I can see him there on screen. So Evelyn, why don't you take it away?
Well, very quick. The projects that I take in private equity always involve, some change and some replacement and adding new talent. So for me, value creation always going to involve adding some new talent and expertise into the team. So, but this would take like a whole day, right? Talk about value creation because they have a lot of different, cases. So it's a case by case situation. But I'm a big advocate that you need to bring new talent and help to create value for companies.
Terrific. Well, Evelyn, Gerson, Jay, thank you so much for your time this morning.